Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. And on today's video, learn from the greatest self-directed IRA investor ever. And I'll get to who that person is. It's a little bit of a sneak peek into what today's video will be all about. So I'm going to reveal who the greatest self-directed IRA investor ever is. And it's not even close. Excuse me. So I'm going to go through that. I'm going to kind of go through who this person is, talk about the mode of operations, the plan, how we can all emulate this strategy. Not all, but a lot of us can. And then talk about potential government attack on this structure, pretty minimal, and how this person was able to build a multi-billion-dollar Roth IRA, and talk about the power of the Roth IRA and how putting into a very similar plan for entrepreneurs and small business owners is super doable. Now, we may not be able to reach the heights of a multi-billion-dollar Roth IRA, but we all can certainly gain the opportunity to follow this plan and generate large sums of wealth in a Roth IRA. So here's some info about me. You guys know who I am. I'm a tax lawyer, written 8 books on self-directed retirement accounts, helped 25,000 plus folks use their retirement funds to generate unbelievable returns and also to invest in assets they know and trust. So we're totally agnostic to the investment. We are on the side of our clients. We want all our clients to do well. We have flat fees. So as your IRA assets build in value, we're on your team. We make the same money whether you make 20 grand or you have a $200 million Roth IRA. So this way there's no conflict of interest, and we're aligned to make sure that you can help yourself grow and take control of your retirement future. So here it is. I am going to reveal who this person is, and his name is Peter Thiel. I even got a picture for you. And this is someone that, I've talked a lot about over the years. I've written many blogs. To me, he's one of the smartest people in the world. As a tax lawyer, is someone that I totally appreciate and respect for how he was able to use the tax code to build a $5 billion, no one knows for sure. There was a ProPublica article back in 2021 that kind of spilled the beans. They got classified IRS information from a whistleblower, a leaker, and they were able to put together a whole profile that was released in June 2021 about Peter Thiel, and they kind of went after a bunch of other billionaires, rich people that used the tax code to their favor. And the Roth IRA, and I've said it many times, I'll say it again, it's one of the best tax shelters, legal tax shelters out there, because it could be employed by almost all of us. You don't need to have a Fortune 500 business or be a high net worth person to understand that if you have money in a Roth IRA and you wait till you're 59 and a half and the Roth IRA has been open at least 5 years, you can shelter all your income from tax. All the income gains and all the appreciation in the Roth will be sheltered from tax. So it's pretty simple. Even my 13-year-old kid understands that. But there is a specific plan that you can implement to follow Mr. Thiel and implement a tax-free strategy. So I'll go through who Peter Thiel is. I'm not getting into his politics. He's been a very big supporter of Republicans and Trump, and he's a libertarian, and he's tried to move his citizenship out of the United States for tax purposes. And I'm not getting there. He's an interesting guy. He's written a number of books I've read. And he definitely has an opinion on government and policy, and even on college, right? He's basically said college is a waste of money, it's a waste of time, and he's put together a program where he basically will give folks money needed to start a business if they don't go to school. And it's not for everyone, obviously, right? But if you are a software developer or interested in coding AI, you may not need to go in school. Like the world's going to move super fast. In the next 4 years, you may be better off working or starting your own AI startup or software startup versus learning about outdated technology and maybe psychology and sociology in college. Now, that's not for everyone, but he says for certain types and categories of people, you're actually hurting yourself by going to college. Now, again, I went to college. I'm pretty educated. I think I would be okay if my kids go to college, but I'd also be okay if they didn't. It also depends on kind of what they want to do. But sorry about that tangent. But the bottom line is he is a super smart guy that turned $2,000 into $5 billion tax free. Okay. Name someone that's smarter. You can say, yeah, Warren Buffett, sure, Bezos, Zuckerberg, Elon Musk. Yeah, they may have more money than Thiel. But Thiel was able to start 3 publicly traded companies, well, 2 founded, and one of the first investors into Facebook. I don't know many people that do that. Usually you can start one company, other than Elon Musk, who actually coincidentally was a founding member of PayPal with Peter Thiel. So he's in a very small group of people, but what I really respect about him is he's able to use the code, and especially the Roth IRA, which is near and dear to my heart. I wrote a book called In God We Trust and Roth We Prosper. So the only difference between me and Peter Thiel, I was on the same page in terms of valuing and underscoring the importance of the Roth IRA. I'm just not smart enough to be a founding investor in some of the three publicly traded companies. That's not something I'm smart enough to do, but at least I was able to understand the power of the Roth IRA. So I'm going to talk about how he did it. We'll go through some history lesson, and then we'll talk about the plan, how we all can kind of emulate the plan. So just real quick, what's a self-directed IRA? IRA is created in 1974. Roth IRA is created in 1997. The whole idea of an IRA is you can make contributions in a tax deductible. Roth IRA would be after tax, but the power of deferral, compounded returns. Your money grows faster when it's not subject to tax. Power of 72. Every 9 years, assuming an 8% rate of return, your money will double. 9% rate of return every 8 years, your money will double. That's deferral. That's compounded returns. Albert Einstein, Warren Buffett coined it, the 8th wonder of the world. And Peter Thiel just kind of took that map and said, okay, I'm going to do it. And I'm going to put the Roth IRA into aggressive investments where there's super upside. And we'll see how he did it. But prior to 1997, there was no Roth IRA. So Mitt Romney's, Warren Buffett's, Michael Milken, they were able to build large IRAs prior to the Roth IRA. Now, in 2010, they were able to convert some of these Roth IRAs because there was a window to do conversions irrespective of income limits, which is still the case today. Even if you're Jeff Bezos or Warren Buffett, you can still do a Roth conversion. Prior to 2010, you were not able to do that if you had above actually a very small income level of $100,000. But the financial crisis erupted in 08, 09, and government needed money. And an easy source of revenue is to get premature tax from Roth conversions. So they never closed that loophole. So even in 2024, you could be a billionaire and still do Roth conversion. Now you have to pay income tax on the fair value of what you convert, whether it's cash or stock or real estate or cryptos, but that opportunity still exists. Now, what happened in the financial crisis is they gave folks 2 years to pay the tax on the conversion. So a lot of rich, high net worth folks decided to do Roth conversions of large sums of money, which was okay because that's what the IRS wanted, and they were able to spread the tax over multiple years. And even though that spreading concept has evaporated, you can still do Roth conversions even if you are high net worth. So the beauty of the self-directed IRA, which again was created in 1974 when IRAs were created, the IRS did not distinguish, and the Internal Revenue Code does not distinguish between an IRA that invests in stocks and an IRA that invests in private stock or real estate. Same rules apply, same prohibited transaction rules apply, same contribution levels, same distribution rules. So the concept is, hey, let's use the power of the IRA or the Roth IRA, compounded returns, deferral, and let's invest them not necessarily in Teslas or GE or IBM, but we can do it in private stock and real estate. And that's what Thiel did. Warren Buffett, Milken, they invested in more publicly traded assets, whether it was bonds or publicly traded securities. Warren Buffett probably in Berkshire Hathaway stock, Milken maybe in junk bonds. But what Thiel did is he was an entrepreneur. He started a small hedge fund in the late 90s and basically said, I'm going to do this to invest in startups. And he kind of opened that world to millions and millions of Americans that said, hey, you can do that and you can make a lot of money tax-free. How do I do that? And that's what really the core of today's video is, to teach people how to do that. So why go self-directed? Obviously, diversify, invest in assets you know and trust. You can do privately held securities. You can do non-publicly traded assets like real estate or hedge funds, venture capital funds, private equity funds, credit funds, real estate funds, cryptos, gold, and much, much more. But again, the core concept is this. This is the power of the IRA. The deductions are great, right? In 2024, you can put away $7,000 to an IRA, $8,000 if you're over 50, which is good. It's money, it's deductions, but this is the power. This is where smart people focus on. Not as much the deductions, but 59.5 in 5 years, everything's tax-free. So the idea is you buy something worth $1, sell it for $5,000, do the math, shelter everything from tax. For smart investors, that is the home run. That's the juice. The deduction is just extra. Now, for Rothers like me, I don't care about the deduction. I'm okay to do away with the $7,000 or $8,000 immediate deduction. If you're a 30% taxpayer, 30% on $7,000 is $2,100. 30% on $8,000 is $2,400. So yeah, I'm losing that potential deduction. But hey, my goal is in the next 20, 30, 40 years, I'm going to have millions of dollars tax-free. So I don't really care about $2,000 current deduction. That's the game. That's the play. So the types of self-directed IRAs, you can do the full service where the IRA is investing directly into the stock, to the real estate, into the asset. You can do the LLC. And I'm not going to spend a lot of time on this because I've done so many videos and blogs and podcasts about it. You guys can check all the videos I've done on the checkbook control LLC, the self-directed IRA full service, and the trust to learn how it works. I've done a bunch of mastermind classes about it that you can find on our YouTube channel. But just want to set the table and give everyone the knowledge of, hey, this is how you can structure your IRA investments. The Roth IRA opened it all up. 1997 was an amazing year because the Roth IRA was created. It was created by Senator Roth of Delaware to give investors a different opportunity, investors that weren't so focused on deductions, but were more focused on tax-free distributions. So Senator Roth created this Roth IRA. I'm not sure if he ever expected someone would generate hundreds of millions of billions of dollars in a Roth. Maybe, maybe not. But the idea is, hey, let's give people a different opportunity to save. And if some people don't care about the deduction, maybe they will care about tax-free savings. So let's get more people into the retirement system. And again, Senator Roth was a remarkable person because I think he understood that, hey, the idea is let's get more people to play in the sandbox. Let's get more people involved in the Roth, into the IRA world. The more people that save, the more people are going to have money based off simple principles of deferral and compounded returns. The more money people have in their later years, the less burden on Social Security and the less burden they'll be on society, okay? Because they'll have their own money, which is super important because if you let people save for a long period of time in a tax-deferred or tax-free account, the math is going to work in their favor. They're going to have more money down the road, okay? Even if they just put the money in the S&P 500, assuming a 9 to 10% rate of return, your money's going to double every 8 years, and 7.5 if you're going to average, 10 or so percent. So if you just do that over 30, 40 years, and you just put money in every year, the math is simple. And I've gone through ad nausea examples over the past several videos, and I can do them again at the end, talk about how this works. But the Peter Thiel is an extreme case of the power of the Roth IRA. Okay, so again, even if you make more in 2024, if you make more than $240,000, you're married, filed jointly, You technically can't do a Roth IRA, but you can do what's called a backdoor, where you just make contributions to an after-tax IRA and then convert it to Roth. So this way, even Jeff Bezos, Warren Buffett could do Roth IRAs in 2024, and you take advantage of the power of deferral. How do you really build a Roth IRA? It's harder to just do annual contributions. The way to build it is to build your account through investments or making Roth contributions to a 401k, which in 2024 is $23,000 or $30,500, or doing it through the mega backdoor where you can do $69K in 24 or $66K in 2023. And there's still time to do 401k plan contributions. So that's a great way to build your Roth and then hopefully make really good investments. And over time, you're going to have a lot of money tax-free in your Roth. And so long as you're 59 and a half and the Roth's open 5 years, it's all tax-free. So let's go into Peter Thiel. Let's get right into the story. He's a smart dude, okay? He went to Stanford Law. He's not a dummy. But you don't have to go to Stanford Law to do what Peter Thiel did. He took a really simple concept, simple foundation, simple math, and just employed it in a remarkable, brilliant way. And that's the story of Peter Thiel, that literally any entrepreneur, almost every entrepreneur and small business owner can do. Okay, so he started a hedge fund in the late 90s. And the Roth IRA, look at the dates, right? 1997, the Roth IRA is created. He's coming onto the scene in the late 90s, 98, 99, right? And he basically went to a self-directed IRA company. It's no longer in business, Penske. And went to a gentleman who I respect enormously, Tom Anderson, who founded Penske, and basically was thinking of doing this with an IRA. And Tom Anderson basically said, hey, there's something called a Roth IRA that was just created in 1997, 98. You may be able to do it. Now, you need to have very, very low income to make the Roth IRA contributions. And we'll see that he actually had very, very low income, right? You need to have less than 110K. He was starting a hedge fund, so it was all going to work out for him. Hey, look, his income was just $73,000, okay, when he started this strategy. So he was starting PayPal with Musk and a bunch of other investors, smart guys, and they didn't know at that point what PayPal was going to be worth, right? It could have been a startup that was worth $1, $1 million, $100 million, right? They started it. So when he bought the shares, he paid 0.001 cent per share, so less than a penny a share. So he bought 1.7 million shares for $1,700, okay? But the IRS looked at this, and people have made the argument that he underpaid for the shares, but all the founders got the same deal. He just used a Roth IRA. The other founders used cash, personal funds, and we'll see why he was able to do this. But at the point he bought the shares in PayPal, PayPal wasn't worth anything. It was literally an idea, okay? They did raise money down the road at higher valuations, and that's where the IRS would make the argument that, hey, his Roth IRA paid below fair value for the shares because within the year, they raised money at a higher valuation. But at that point, this is the key fact, all the founders pay the same amount for the shares. Whether they use the Roth IRA or personal funds, they all paid the same value. And I think that's ultimately the most important fact. So this is the strategy, right? Here's the first part of the strategy. Use your Roth IRA to buy shares or buy an asset at a very, very, very low value that you believe is going to go up in value. Now, we don't have a crystal ball. We don't know what things will happen in the future, but look at his bet. His bet is $1,700, which if PayPal failed, okay, he lost $1,700. In 1999, $1,700 was worth a little bit more than it is in 2024, but it's not like you're losing your house, right? His life was going to go on. So he took a very, very small amount of money, very, very low risk, and he put it in a very, 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 very high reward environment, which is founder shares in a startup. And this was internet boom, right? Late 90s. If you guys were around at that point, San Francisco, I had a bunch of friends that was in Silicon Valley at that point. It was super exciting. I was in law school, and a bunch of my buddies, we started a legal document online company. It never kind of took off. We just didn't have the right technology. We had a great idea. This was like before LegalZoom. I may have not been sitting here, probably been worth a lot more money, but we just had the wrong developers. It never kind of took off, and but that was on us. But this was a very exciting time. I kind of equate it to like 2015, 14 with cryptos. So many exciting ideas, new companies being born, really, really fun. So Thiel came in right time, right? Life is all about timing. I always say that. Like, I met my wife at a bar, and we always say that if we met at different times in our life, we probably never would have got together, but the timing just worked out. So just like Thiel, he got to San Francisco at the right time. Internet boom, Roth IRAs created in 97. He's getting into PayPal in the late 90s, 98, 99. Everything's working out for his favor. So a lot of this is from the ProPublica article, and you can check it out. Just Google ProPublica Thiel. It's a June 21 article. And again, they have some really good details because someone leaked them all this information through illegal activity. And this person was apprehended, actually, because they leaked sensitive tax information, not just Thiel, but to many, many high net worth individuals. And ProPublica went with it. So we can see here, the record revealed that employees got the same below fair market value pricing, which is what the IRS acknowledged when they audited Thiel in 2012. So it was too late, right? Because this happened in the 90s. There's a 3-year statute limitation. They audited Thiel. They couldn't do anything with him. What they did do is in 2014, they published a Government Accountability Office report, which I'll talk about shortly, which kind of mirrors the Thiel case and kind of talks about what he did, and then also reveals how kind of in the dark the IRS is and what an uphill battle they have to kind of attack these types of transactions. So soon after the company sold him the shares, the investors, they got investors to invest millions of dollars in the company, which is what the IRS was focused on. But the facts are, when Thiel and all the investors invested into PayPal, these future investment deals were not signed, did not materialize, were not locked in. So the value they used at the time was accurate and fair. Okay, so the company sold a slice of itself to investors for $500,000, so a little bit more, and then later that year for $4.5 million. Okay, so they bought in at $1,700. They got par shares at 0.001, and then within the year or so, they started selling slices of the company at higher valuations. Now, if those values were locked in and they had signed definitive LOIs, then maybe the IRS would have a case. But from what I understand, that was not the situation. So in just a year time, the value of the Roth jumped, right, from $1,600 to $3.8 million, a 230% increase. Then in 2002, this is the juice, right? eBay, so about 3 years later, eBay buys PayPal, okay, and at the end of 2002, his Roths were $28.5 million. Okay, so in less than 3 years, Peter Thiel turned $1,700 to $28.5 million tax-free in a Roth IRA. Now, that's just the first of the 3 giant transactions he did in his Roth. So that on itself is really damn good. $1,700 to $28.5 million tax-free. That's darn good. Okay, I've seen it. I've seen these situations over the years. Stuff happens. It's not just Peter Thiel. Okay, I have clients that have emulated this stuff. Anywhere from 1,000 to 20,000 to 100,000 who've turned it into many millions tax-free. So this is the plan. We're going to get to the playbook in a minute, but you can see here's the facts. First transaction, PayPal, $1,700 within 3 years, $28.5 million tax-free in a Roth IRA. Then he found Palantir. Okay, this was 2003. So a year after PayPal, him and a few founders fund Palantir, which is a basic company that has contracts with the government and uses data to provide information. And basically, he uses his Roth IRA again to fund Palantir. We'll talk about the prohibited transaction rules, how he was able to do that. But essentially, Palantir goes public down the road. About 15 years later, it goes public. And he generates, no one knows exactly how much, but it's believed billion plus tax-free from his shares that he used his Roth IRA to buy in Palantir at par value, again, probably less than a penny a share. In 03, Palantir wasn't worth anything, right? It was an idea on a napkin. And within 14 or 15 years, he's generated $1 billion plus tax rate. That is much harder for the IRS to attack than the PayPal deal, even though the dollars are smaller, because he was able to raise money, within a year at a higher valuation. You can understand why the IRS would come in and say, hey, you did not use a fair valuation to value your PayPal shares at 0.001. It should have been valued higher because you raised money at higher valuations within the year. Now he's going to say, well, that wasn't locked in. There was no guarantee that that valuation would occur within the time frame, and that was the value at that time. It was a startup company. Okay, so he's got PayPal, he does Palantir, and then Facebook, which actually happens after he starts Palantir. That's why I put Palantir before. He meets Mark Zuckerberg in Silicon Valley in 2004, and he becomes the first investor, basically outside investor, first venture capitalist investor of Facebook. He puts $500,000 from his Roth IRA, from the money he made from his PayPal deal. He puts some of that in Palantir, and he puts $500K into Facebook, and he turns that in 4 years to $870 million. You can't make up these numbers. Now, I celebrate these numbers. To me, this is the American dream, right? You're smart, you use the tax code to your advantage, you make investments into risky companies, right? Obviously, we're not talking about the failed investments with his Roth IRA. It's not like he only made 3 investments with his Roth IRA and they all hit. No, he, I'm sure, made many, many, many investments with his Roth IRA, and not all of them were successful. But the risk reward is the proposition, right? Small amount of risk, 500K, a lot of reward, 870 million. PayPal, small amount of risk, $1,700. He got big reward, $20.5 million. Palantir, we're not sure exactly how much he invested using his Roth IRA, but assumingly quite small, and billion plus in the Roth IRA. Okay, here's the playbook. This is it. This is the whole key. This is the most important part of the video. These are the keys, and I didn't put it up front because I want to make sure people are watching the video and they can understand how it works, the story, the power of the IRA, the power of the Roth IRA, why Thiel was in the right place at the right time. The Roth IRA was just born. Silicon Valley was erupting, internet boom, and he just, made it. And this is the 3 points. Okay, I'm going to spend the rest of the video on this. Obviously, why say startup shares? It could be anything. It could be real estate. It could be profits interest in a venture capital fund, private equity fund, real estate fund, hedge fund. It could be Bitcoin. It could be the next digital asset, NFTs. The key is you buy something cheap. Okay, you pay. It's basic math that, again, you learn in grade 1. You buy something cheap. Any idiot can sell something. You make your money when you buy. Talk to any good real estate investor, any good equity investor, any good investor. You make money on the buy, not the sell. Any moron could sell something that's valuable, right? You buy a Picasso in the 50s, that's smart. You sell it in 2024, I can do that, okay? You buy assets that are cheap, and you take very, very low risk, high reward. You pay the fair market value, right? That's key. You can't go to someone with an established business that has 50 million in revenue and say, hey, I want to buy 10% of your business for $1 or 10 grand or 5 grand. Like, the IRS will eat that up. They will destroy that. Okay. You have to pay fair value. But guess what? When there's a startup, when the assets are already low in value, you're buying Bitcoin in 2012, you're buying a new digital coin that has a 1 penny value. It's easy to argue that value because it's new. It's a startup. It has no intrinsic value. It has no goodwill. It has no balance sheet. It's easy. And then obviously the key in the equity setting, you have to own less than 50%. Okay, and I'm going to go into that. That's why it worked in the PayPal, Palantir, and Facebook for Thiel. He owned less than 50% of all the companies. If he owned more than 50%, or a high percentage close to 50%, he would potentially trigger a 4975C, which says that an IRA owner, a disqualified person, cannot control an entity, own more than 50%, and have their IRA invest. That would automatically trigger a prohibited transaction. So Palantir, he owned less than 50%. PayPal, we know he had multiple investors own less than 50%. Facebook, he put in 500K at a higher valuation. He owned less than 50%. So he bought in at a low value, high reward, low risk. He paid fair market value, and he owned less than 50% of the entity. And we're going to see in the 2014 GAO report, Government Accountability Office report, the IRS was stuck. They couldn't attack his transaction. And that's the model. So the key one, as I mentioned, high reward, low risk investments, small amount of money, assets that have low value, no intrinsic value, no goodwill. The lower, the better. You can get away with paying less than a penny a share if it's a business idea on a napkin. And that's the whole idea. Would I suggest putting $1 million into a startup from your Roth IRA? Probably not. $1,700, $2,000, $5,000, $10,000? Yeah, all day long, baby. I can live another day if I lose that money. As long as the upside, you have to understand the economics of the deal. I can't tell you if it's going to be a good deal. But if you say, hey, I'm investing with these guys, they've done it before, they're smart, let's all get in at a low value. Yeah, we may raise money in a year at a $5 million value, but right now it's an idea on a napkin. Let's get in cheap. Let's put in $2,000 in a Roth IRA. We'll each own 15, 20%. And then when we get investors, we'll start selling the Roth IRA shares to the investors. That's how you do it, right? Four people come together, each own 25%, put in $5,000 from their Roth IRA or $10,000, whatever it is, start the business, hire some lawyers, maybe operate it as best you can, go raise money. And then when you raise the money, you either dilute your Roth or your Roth selling shares at a higher value, and right away the money's going back to the Roth, right? If you paid a cent a share and now you're selling at $1 a share, that money's going into the Roth IRA. And whether you then contribute the money to the company or then the company issues more shares and sells the shares, however it works, as long as you're locking in your equity at a low value, that's what matters. Now, earlier the better, right? People come to me and say, hey, Adam, I got a business. I own less than 50%. I did $7 million in revenue last year. I'm like, okay, what's it worth? I think the company's worth $40 million, $50 million. Okay. Do you have enough money in your Roth IRA to buy anything? No, I have 20 grand in my Roth IRA. So you want to buy 1%, 0.1% of your business? It's not worth your time. You needed to come to me when the business did 100,000 in revenue, 200,000 in revenue, or zero. That's when you need to do that. That's why I'm doing this video. This is really for any future entrepreneurs that are doing future deals, right? You could be a mature entrepreneur in your 70s, 60s. This is for the next deal, okay? Or you can be a 20-year-old entrepreneur that says, hey, I'm going to do this deal for my new company. I'm going to own 30%. Maybe I'll put 5% with my Roth and the rest personal. Why would I say that? Well, if you're in your 20s, you may not want to wait till you're 59 and a half to get full liquidity. Like Peter Thiel, he is in his mid-50s. I think he's 54. Let me check. So he's actually going to have to wait a little bit to pull the money out. He's 56. So he's going to have to wait 3.5 years or so to pull the money out. Now, he has taken distributions from his Roth. So he's paid tax and a 10% penalty because he just wanted to use some of that money. But for him to get full tax shelter of all the Roth, he's going to have to wait till he's 59 and a half. So he's going to have to wait a couple more years. He's just 56. So if you're 22 years old, you may not want to put all your money, all your shares in your startup in a Roth because you may have to wait 40 years to tap into it. And I assume you're going to want to buy a house, get married, buy yourself something. So you're going to want to plan accordingly. But earlier the better, high reward, low risk investments. I said C Corp versus LLC. Why? If you watch videos, the startup should be in a C Corp because you're going to block the UBIT, unrelated business income tax. If an IRA or Roth IRA owns an LLC, if you have more than $1,000 of allocated profit to that LLC, there's a UBIT tax which can go as high as 37% on the net income from that LLC. Okay, when it hits around $15,000. Now there is still capital gain. So if I have an LLC interest, someone buys my LLC, UBIT shouldn't apply to that capital gain transaction, assuming there's no leverage. But if I had a C Corp, I'm going to block the UBIT and I'm still going to get capital gains when I sell my shares. So for Thiel, Palantir, PayPal, Facebook were all C Corps. He didn't have to work with UBIT. If they were LLCs, potentially have to deal with UBIT. Now, he may have not cared because the company would have issued him a tax distribution to help pay the tax on the UBIT. So just you have to consider those implications. But this is the most important part of everything, right? Obviously, the Roth IRA is paramount, right? You can't do this without the Roth IRA. The good news is anyone can set up a Roth IRA. You just need some earned income. Even if you make more than 240, you can still do it. Just do the backdoor. This strategy does not require a lot of money. We see it with Thiel. Earlier the better, the cheaper it will be, less risk, higher reward. Okay, that fair value. This is where the IRS goes crazy. Okay, this is the biggest risk, is the IRS to come in and say, you didn't pay fair value. If you're under 50%, it's going to be very hard to argue prohibited transaction. Okay, there is some case law where there's a case, for example, Rollins v. Commissioner. It's an older tax court case, 2004, I believe. And this guy Rollins was an accountant, and he had a bunch of businesses he owned less than 50% of. The problem is Rollins needed the money. The companies were going bust. So he took his 401k and lent the companies money at prevailing interest. And the IRS audited him. They argued prohibited transaction, self-dealing. And he said, what do you mean? I'm under 50%. Go away. You can't fight me. And they said, no, self-dealing. Because you needed the money, your 401k only made the investment to protect you, to protect your personal interest in the business. The 401k did not make the investment to benefit the 401k. This was done exclusively to benefit you personally, Rollins. That's why we're going to blow it up. And the tax court agreed. These cases are different, right? Because if you're putting $2,000 in a startup, how's the IRS going to argue that the startup needed the $2,000? Much harder, right? But on fair market value, they could make an argument to say, hey, this was a self-dealing transaction, or it lacked economic substance. We're going to blow it up. So a couple tips. All investors should pay the same amount at that point. You shouldn't have any signed agreement of a higher value in the coming year or months, right? So I raise money, I start a business, I say the company's worth $5,000, right? So I buy in at a penny a share, or I put in $1,500, and my partners also put in $1,500. So we each own 25%. And then a week later, I go raise at a 7 million value. That's not a good fact. If I raise a year later a 7 million value, okay. But within a week, months, doesn't look great. You may have good facts. You may be able to say, hey, this guy came out of the blue. We developed this new AI technology that we didn't have when we gave ourselves the value on our napkin when we were sitting at the diner. And now we have this new technology through AI, and the company's worth $1 billion. That could be possible, but it is easier. You are opening the door just slightly by playing around with the value. So if you start early, no one's going to argue value because the company's not worth anything, right? It's got no balance sheet, no books. So the earlier, the better. Don't have any tied in value deal that is in the short term. And it's hard for the IRS to argue value. It's another thing that this GAO report from 2014, which I encourage all of you to check out. You can just Google 2014 GAO report. I actually will put it in the video notes. It's actually very interesting, and kind of feel bad for the IRS because they basically are saying, God, we don't really know how to attack this stuff. So I'm going to put it in there. It's an interesting read. They actually kind of go through the Peter Thiel model with some graphs and diagrams. It's interesting. So the value is the hardest part because they also allow for different valuation metrics like liquidation value, right? If you are using a profits interest or a carried interest, you can use the liquidation value, which basically says whoever puts in money gets the money first, whoever doesn't gets the money after. So if you put in no money and the liquidation section of the operating agreement is based off positive capital accounts, then your profits interest is worth zero. So that means you can literally pay zero for the profits interest, meaning the carried interest of the profits interest at grant could be worth zero, probably is, and in the future could be worth millions and millions of dollars. Founder shares, there's different valuation premises that could be used. And it's very, very hard for the IRS to argue facts and circumstances. It's just very hard. They don't like adjudicating cases that are based off facts. If it's clear violation of law, like, hey, I own 60% of the company and I use my IRA to invest, they'll just nail you 4975, easy case. You hold gold in your house, they're going to nail you. It's easy. They'll take that to tax court. The facts-based cases, they don't want to take to tax court. That's why there's only a handful over the last 25 years, because they're hard to litigate, they're expensive, they take time, and there's no clear answer. And the IRS does not like to lose. Key 3 on less than 50%. Why? Because if you're under 50%, it becomes a facts and circumstances test, harder for the IRS to win, and they don't like to lose. Because they also have a risk-reward profile when they look at a case and they look at a situation. And if it's not a slam dunk, they may not want to invest the time and the effort, especially if you only have a few $1,000s at stake. Now, under 4975, the way it works is when you do a prohibited transaction, the IRA is deemed invested on the day it happens. So if you're doing an investment of $2,000 into a startup, even if that startup goes to $75 million and they feel it's prohibited, they have to invalidate that transaction at that point when it's worth $2,000. So they're only taxing you on that. Now they can try to argue penalties on a disqualified person. You didn't satisfy, you didn't correct. Those are much harder. So it's generally at the time the transaction occurred, which in the case of these deals are tiny, right? Like Thiel put in $1,700 in PayPal, $500,000 in Facebook. So even if they nailed him, the tax revenue would be far lower, because the rules suggest that when you engage in a prohibited transaction, the IRA is blown up on the day of the transaction, not on the future day. So standard 50%, pay value, fair value, start early. Very, very hard to attack. Now the Rollins case, again, they were able to attack a transaction where Rollins owned less than 50%. It was bad facts. I mean, Rollins needed the money. And if the 401k didn't lend the money to the company, he maybe loses his personal investment. When you put 2K in a startup, it's going to be awfully hard for the IRS to argue that this company needed the 2K to keep going. Okay. That's the IRS attack. They couldn't get him. They audited him in 2012. It was too late. They had nothing on him. 3-year statute of limitation. Very hard how do you even find Peter Thiel, right? They only can look at a 5498. That's the only thing they get, which shows the value of the IRA, on a year-to-year basis, okay? So yeah, they can gather all the 5498s. Then they have to send them to the small business SBSE department, who then has to compare them to people's tax returns and see if there's any grounds for audit. The IRA isn't disclosed on the 1040, your personal income tax return. If you're not taking a distribution or it's a Roth IRA, it's not going to show anything. It's not going to show the activity of the Roth IRA. It's not going to show the value on your tax return. The only place that's going to show the value is the 5498. So if they're not looking at the 5498, they're not going to be able to know what your Roth IRA is. So if they just look at my 1040, I could have $1 billion Roth IRA. They'll have no idea, because I'm not taking distribution. So it's not going to be on my 1040, and I'm not taking a deduction. So it would only be on my 5498. Now, the IRS doesn't even disclose IRA audit rates. No, there's not an IRA IRS audit division. Zero. IRAs get audited by the small business self-employed division. Okay. So fact. 401ks do have the Department of Labor. The IRS will look at 401ks. Very small audit risk for solo 401ks. They will risk even 990Ts for UBIT. IRAs do not have a specific IRS audit division. Take that for what it's worth. I don't know who gets audited. I can't tell you. We're a regulated trust company. We follow what's called the SARS, Suspicious Activity Report. If you are following the news, Stormy Daniels, Trump, how did they catch Trump? Deutsche Bank followed the SARS. Suspicious activity. They saw money going to a random LLC, porn star. I don't know if knew who Stormy Daniels was. Deutsche Bank flagged it, and I guess no one knows what happens. The Department of Treasury, they don't even tell you what happens with these investigations. So let's say you had a client that went from 2,000 to 200 million. We'd probably file SARS if it was within a year, right? That's suspicious. Now, do we know what happens? Will the IRS audit that person? We don't know. So that's just something to consider. But again, there's no IRS specific division of audit for IRAs. I've been doing this 14 years. I've had one client audited, and it was literally my first 2 years in business. And I've mentioned this. He was a doctor in his 70s in New York. He actually came from New York State, and they were focused on valuation of his IRA. I've never had a client audited for prohibited transactions. I never had a client audited, as far as I know, and I would know because we would probably have to participate in the audit for any valuation issues. And we do have a full IRS audit guarantee, something we're proud about, that will work with you in countering any IRS investigation. The GAO report, which I included the link in the notes, it's very interesting. And they basically go through the whole idea of founder stock, the Peter Thiel model. They go through the profits interest, carried interest in a Roth. And they basically say, we have some challenges. Number one, it's hard to prove value. These are startups, carried interest, liquidation value. Second, statute of limitations. By the time the value gets to 200 million or 50 million or 28 million, it's generally more than 3 years, right? If you're investing in a startup, it's super rare to have a 3-year exit where you go from 0 to 300 million. This eBay model is very, very unique. You're talking, again, Peter Thiel and Elon Musk and some other very, 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 very super smart people. Most people, it can take 10, 15 years to go from 0 to even 50 or 100 million of equity enterprise value. So if your Roth IRA owns 10% of that, that's a significant amount of money, but the 5498 will likely not show that valuation until many years after, right? So a lot of times for the first 3 years, the clients will literally value the company at what they paid for it, because there's no material event to suggest the business has changed materially in value. So maybe after year 3, 5, 7, they'll start seeing an increase in value. They'll adjust the 5498 upwards. But if the 5498 is not adjusted upwards, the IRS is not going to know the value of the IRA, and hence they're not going to really be able to audit it. So the 3-year, the hard part of valuing Roths, and the fact that the IRS does not have audit skills to understand prohibited transactions, to understand this stuff. So super complex. Even though it's not hard to understand, just knowing that you can or cannot do this or how it works, they said it's very challenging for audit folks in the IRS to understand the rules. Why? There's no specific IRS audit division for IRAs. Now, I always give this example. I'm a pretty smart guy, pretty well educated. I have a law degree. I have a master's in tax law. I worked with some of the largest law firms in the world. I never heard of a self-directed IRA till my 8th year as a lawyer. So how could someone who's an auditor in the IRS, not a lawyer, who probably has never seen an IRA audit, kind of understand these rules and understand prohibited transactions and how all this stuff works? They wouldn't even spot the issue. And that's just the truth. And it sucks for the IRS. It's an uphill battle. The good news is, again, I've been doing this 14 years. Maybe it's my clients, but people are not looking to game the system. People are scared of the IRS. People do not want to do illegal stuff. People are conservative. So I don't think there is a lot of IRA abuse out there at all. Very, 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 very small. That's why the audit numbers are low. I think if the IRS really felt there was a lot of shenanigans and a lot of illegal prohibited transaction stuff, I think they would find a way to audit these IRAs more closely, but they're not, because at the end of the day, the IRS needs money. And if they're spending time on an audit, they need to capture money. And also from a policy standpoint, it's not great public policy to invalidate people's retirement accounts, right? It just doesn't show well in the news. So they kind of shy away from it for what it's worth. So again, the GAO report, worth a read. The key pages are page 30, 37 or so. I would just do founder shares, do an edit find for founder shares, and then you could basically look at some nice pictures and diagrams, and they'll outline essentially what Peter Thiel did without using his name, and then and also basically giving you the playbook on how you can do this for a carried interest in a private equity, venture capital, or hedge fund. It's awesome. They basically give us the blueprint how to do it. It's like going into a bank and the bank's like, this is how you can rob the bank if you want to. FYI, like our cameras don't work here and security guard goes for lunch here. So like if you want to rob the bank, this is how to do it. The IRS is basically saying, hey, if you want to do this legally and put founder shares in a Roth IRA, put a carried interest in a Roth IRA, this is how you do it. And guess what? We probably aren't going to be able to figure this out. So good luck. So anyway, this is, again, the three keys: high reward, low risk, start early as you can, pay fair value. And then thirdly, stay under the 50% threshold if you're investing in a entity, whether it's to own founder shares or get a carried interest. I talked about the audit challenges. There's very extensive challenges the IRS is facing in this regard, unfortunately. Adam, you're the best. Thank you. Appreciate it. I try my best. I love this stuff. I do think there's no one better at this stuff in the country. I think that's pretty obvious. But it's a subject that once you get into, you love. But there should be 10,000 people watching this video because I'm literally telling you how you can shelter millions of dollars tax free. If you're an entrepreneur or a small business owner, like this is a must watch. It's more important than almost anything you're going to do for your startup business. It's structuring the right way. But I don't know. People hear IRAs, Roth IRAs, their mind goes blank. They don't understand this stuff. And it drives me crazy. But all I can do is focus on my clients. And I love to have a growing client base. And I love talking to more and more people. But it's frustrating because there should be 10,000 people watching this video. But my clients get it. And everyone who I talk to and everyone who watches these videos become smarter and savvier and better smart Roth investors. So, one person at a time, that's my goal. Even if I can change one person's thinking and get them planning ahead with a Roth IRA, whether they use IRA Financial, they use another company, they use Fidelity, Vanguard. Obviously, I'd want them to use my company because I think we're the best. But I think the strategy is that important. There's so many people that can use it. 65 million IRAs. What percentage of these people are entrepreneurs, small business owners that have the opportunity to even be a passive investor into a huge, huge upside investment? And they're not even thinking Roth. They're just like, oh, I'll just take my personal money. Here's a check for 50K, 20K, 100K. And they have the Roth sitting there and they can do it, right? How many people sit around a bar, come up with a business idea, put a little bit of money in, and it grows. And they're like, oh, now it's too late. We did $1 million in revenue or 500 grand in revenue. And it's like, oh, I own 30%. It's too hard to get my Roth in. Even though it's doable, I'm too lazy. And they just kind of forget about it because guess what? With the Roth IRA, you need to be patient. You got to trust the process, but it works. And I get it. A lot of us aren't very patient and just want instant gratification, instant reward. And if you look at Peter Thiel, the PayPal thing happened pretty quickly. But Palantir took him 10 years, right? Facebook took him 4 years. Like it does take time. Now he's 56. He's still waiting for I'm sure he's going to throw one hell of a party when he hits 59. Maybe he'll invite me. But he's patiently waiting and he's still doing deals in his Roth. So even if your Roth is growing, you can still do deals in your Roth. If you have to take taxable distribution and pay tax and a 10% early distribution penalty, I guess you can do it. You can probably find ways to kind of tap into that money. But this is the best way to invest and start a business. It's literally the best tax shelter out there. It's legal. The IRS is aware of it. They put a GEO report 10 years ago. They know that's out there. They're not. They've given us the blueprint on how to do it. It's our job to take advantage of it. And it's my passion to educate people and explain that, hey, you can do it. It's not intimidating. It's cheap to do. You can get a Roth IRA with us for $460 a year, like flat. It's not expensive. You don't have to hire a law firm and pay them 30 grand to do this. So it's frustrating, but more and more people every year are seeing the light and understanding the huge opportunity of the Roth. I think it's more who you know than what you know when it comes to getting into these types of investments. Yeah, Carla, I mean, I agree. I mean, that's actually one thing the IRS said. even in the GAO report and even in the ProPublica article, the one issue they said is like a lot of average people just can't get these deals in. And my comeback to them is it's because you have these accredited investor rules, right? What is an accredited investor? A lot of these private placement deals, if you earn less than 300K or have less than $1 million in net worth, excluding your primary residence, you can't do a lot of these deals. So that's why a lot of these opportunities are not marketed to like middle-class folks, or low-income and middle-class folks, because they're not accredited investors. So if you got the accredited investor rules, if you took those away, then I do believe, Carlo, these investments would be marketed broadly and to a greater segment of the American population, and thus more people would be able to be aware of them, learn about them, understand them, and invest in them. But because of the accredited investor rules, they're not marketed to those folks, so they lose them. So even if they were marketed to them, they wouldn't get the opportunity. So Thiel was able to do the PayPal because he was a founder. He was able to get in. So he didn't need to be an accredited investor. So this is just another reason. So the government points and say, oh, only rich people get rich doing private placements or hedge funds or private equity. It's not fair. But they forget to remember that they created these rules to allow rich people to do this. If they took away the accredited investor rules or expanded, they have Reg CF, which is a crowdfunding reg that anyone can invest in. The problem is it's limited to a $5 million round. Now, a lot of deals are bigger than $5 million. You can't make any money if you're promoting a $5 million deal. So those are only small deals. All the big, juicier ones require accredited investors. And if you're not accredited investors, you don't get the opportunity to invest in the deal, which is counterproductive and hurts low to middle income people. And the government says, well, we're protecting those people because we don't think they're smart enough and they can absorb the loss. And I said, well, you're actually hurting them. You think they're stupid. They're not. And you're not giving them the opportunity to make the money like the Thiels, the Warren Buffetts, and other high net worth people that get exposure to these types of deals because they're marketed. So Romney did it. He just did a pre-tax. Buffett, Milken, and you're next. Your name. Hopefully, I'd love to do another video next year in 5 years and say, hey, client John Doe, he did this. And I won't use your name, so I don't want the government to come after you. But I love hearing these stories. And I have so many clients. I want more, hundreds and hundreds of clients that have turned 10,000 plus into millions. Okay. We have 3.3 billion in assets. And those are clients. It's built off just smart people. And that keeps growing because people keep making smart investments. So if you are cutting edge and you want to make interesting investments, IRA Financial will not only set up your IRA, it will help you navigate the rules, will consult, help you structure, and give you the secret sauce that no other company can do. And we are the leaders. If you are a sophisticated investor, you want to know how to put founder shares, carried interest. There's other strategies that I'll save for another day. But we are at the cutting edge. I've written 8 books. Anything out there I know about, and I present and share with just my clients. So thank you guys for watching. I hope you guys have a great day. Thanks so much. Hope you enjoyed it. This was a great topic. I love this topic. And again, put away Peter Thiel, whether you can like him or not. And it's not important, his name and who he is. What's important is to remember that this is the playbook, right? Roth we trust, invest in appreciated assets with a Roth, high reward, low risk, earlier the better, low value, preserve, wait, keep all your appreciation, income gains tax-free, pay fair value, make sure you own less than 50%. You're going to be a tax-free millionaire down the road. I promise. Okay. It's almost guaranteed. Thanks again. Appreciate it. If you have comments, questions, leave them. I'm actually doing a breaking YouTube live tomorrow, Friday, I think noon Eastern, on new requirement of distribution. Well, new IRS announcement. Basically, they're pausing the RMD rules, so you don't have to do RMDs in 24. They paused them for the last 4 years because they literally can't get their stuff together. It's embarrassing. But they created all these really complex RMD rules, 10-year rules, lifetime expectancy. No one understands them. They don't get them. They don't understand. So they basically are just pausing them for people because they don't. I don't understand why they just can't write the regs, but they're looking to spend more time reviewing comments. But either way, if you want to learn more about requirement and distributions, what that means, pausing the RMDs for 24, I'll be doing a YouTube live on Friday tomorrow. So if you're watching this tape, then just check that out because it's on our YouTube feed. Otherwise, have a great day and see everyone again soon. Thanks.